Strategist at Laffer Frischberg, and Dean Curnutt is the president of Macro Risk Advisors, both joining us remotely and hopefully able to hear me. Let's start out, if we can, Dean, with you. Do you believe in this rally? I mean, if we take a breather today or not, is it meaningful?
Well, you know, bear market rallies are typically violent, and that's what we're reminded of this week. Shorts tend to cover all at once. The easy trade has been to be short. Barring any real improvement in the fundamentals, which we see as a deteriorating environment for the consumer and a global debt overhang, we don't see this as a sustainable rally.
And what do you think, Daniel? Do we need to see?
Yeah,
more?
no, I totally disagree with him. I see the same terrible fundamentals that he sees, but we do a market x-ray, and what we see is real demand for stocks that is increasing, not narrowing. As we get to the point where sellers came out back in November, they're not coming this time, so you have reluctant sellers and more growingly aggressive buyers, and so I think this could go for a while. And remember, this is the rally that we talked about a month or so ago, saying that it would probably start around now, and I think it could go quite a bit further.
So you're still on track to chase this rally. You're not calling
I'm
the
not
bottom
chasing
per se,
it.
but you think that this rally has more to it.
That's right. I wouldn't call it a bull market yet, but I think it has a good deal more to it, and there are reasons for it. There are legitimate reasons why people feel better right now than they did before.
So how about that, Dean? I mean, are you refuting that this rally even has more legs in it? I mean, the typical bear market rally can go to 25%.
No doubt. When you're starting with the S&P down about 680, 30% gets you up to 900. I mean, that doesn't do much to repair the wealth destruction that's taken place here. We learned today from the Fed that the consumer lost $11 trillion. So consumer household balance sheet is now $11 trillion less than it was. And, you know, we've got credit spreads that are sitting there at some of the widest levels since November. Volatility is down, so that, you know, might mean that some of the financial asset overhang is starting to unwind a little bit. I think it speaks, though, to the fact that the Fed has backstopped nearly everything, and, you know, frankly, we're sort of out of bullets to some extent.
So what do you buy now, Dan?
Well, I think you buy companies like Mosaic and exchange-traded funds like MOO, M-O-O, which is agricultural, chemicals and fertilizers and things like that. I also think that you can buy RIG, the Transocean, which is a deep water drilling company. There are a lot of places that we're seeing that are looking very, very good right now. But more importantly, besides the things that you can buy, we're seeing the people who do private deals are seeing that the Chinese sovereign wealth fund, the Saudi sovereign wealth fund, instead of wanting to cash in their dollar holdings, they're looking around in the United States now for bargains, and that's really important.
Dean, final word to you. What do you like in this marketplace, given what you've said?
Well, outside of puts on the S&P 500, which we think are, given the risk overhang, pretty cheap ways of expressing a short position. Look, we're looking for fundamental stabilization in the banking system, which, you know, in a week like this week, which has been obviously a good one for the bulls, you still had 15% daily moves in the banking system. That's not really an investable market from our perspective. So we're laying low. We're looking for the consumer to right himself. We're looking for job creation and of course, a better partnership between the new administration and the markets.
All right, guys, thanks both very much. Appreciate it. So just about 50 minutes to go until the closing bell.